Behavioral finance is a field that combines psychology and finance to explain why investors often make irrational decisions. Unlike traditional finance, which assumes rational investors and efficient markets, behavioral finance highlights how emotions, cognitive biases, and mental shortcuts shape financial behavior. This field helps explain phenomena like market bubbles and crashes, why investors overreact or underreact to information, and why individuals consistently make poor financial decisions. Our lecture provides a deep, intuitive, college-level overview of key behavioral finance concepts, built on two pillars: heuristics and cognitive biases. Prospect theory, developed by Kahneman and Tversky in 1979, challenges the classical assumption that investors maximize expected utility. A key idea is that people value gains and losses differently, exhibiting asymmetric responses. Losses hurt more than gains, please, a phenomenon known as loss aversion. For example, investors are often risk-seeking when facing losses, yet risk-averse when facing gains. Mental accounting describes how people separate money into different mental accounts, despite its fungible nature. This means treating a tax refund as extra money rather than part of regular income, or spending more freely with credit cards than with cash. Heuristics are mental shortcuts used to simplify decision-making, but they can lead to systematic errors. The availability heuristic causes us to overestimate events that are easy to recall, while the representativeness heuristic leads us to see patterns in random data. Anchoring bias involves over-relying on initial information, even if it's arbitrary. Overconfidence bias causes investors to overestimate their own skills and knowledge, leading to excessive trading and underestimation of risk. This illusion of control often results in concentrated portfolios and higher transaction costs. Famous day traders, for instance, consistently underperform markets because they overestimate their ability to pick winners. Herding behavior describes investors following the crowd, often assuming others have superior information. This was evident in the dot-com bubble of 1999 to 2000 and the housing bubble of 2006 to 2007. The disposition effect is another common bias, where investors sell winning stocks too soon and hold on to losing stocks for too long. This often happens with the hope that losing positions will come back, while winners are sold to lock in gains. Behavioral finance also provides explanations for market anomalies like bubbles and crashes. Bubbles are often fueled by herd behavior, overconfidence, narratives, and the fear of missing out. Historical examples include the Dutch tulip mania of 1637, the dot-com bubble of 2000, and the cryptocurrency bubbles of 2017 and 2021. Crashes, conversely, are driven by panic selling, a flight to safety, overreaction to bad news, and liquidity-driven selling. Limits to arbitrage, as proposed by Sheffrin and Statman, explain why mispricings persist. Investors construct portfolios not like rational optimizers, but rather like layered pyramids. This approach, while not mean variance efficient, is psychologically appealing. Behavioral biases also affect corporate finance, influencing decisions made by CEOs and CFOs. Overconfidence can lead to overinvestment in acquisitions, while loss aversion might prevent managers from cutting dividends. Over-optimistic forecasts can also lead to capital budgeting mistakes, ultimately destroying shareholder value. Fortunately, understanding these biases allows us to implement strategies to improve financial decisions. These include avoiding frequent trading, using dollar-cost averaging, actively seeking disconfirming opinions, and implementing stop-loss rules. In summary, behavioral finance explains how cognitive, heuristic, emotional, and social biases lead to suboptimal financial decisions. By understanding these influences, investors can reduce errors, build more robust portfolios, and align their financial strategies with both their financial and behavioral needs. Thank you for watching this video on behavioral finance. We hope this information helps you make smarter, informed decisions.